Welcome, everybody. This is a webinar that is sponsored by CraneShares, Henry Greene, the man to talk about opportunities when it comes to income investing in Asia. We're going to be talking about, and he's going to be talking about how they could be a really interesting opportunity, especially in the context of all the things we're seeing with tariffs and geopolitical dynamics. So, Henry, all yours.
Thanks, Michael. And thank you, everybody, for joining. It's my pleasure to be here today to talk to you guys about, what we think is a really exciting opportunity. And it's a space that we've been active in it for a while and have been looking at. And now we really think, given the current conditions in U.S. fixed income and global fixed income, we think now is a really interesting opportunity for this strategy. So let me just go ahead and share my screen. There we go. All right. So we're going to be talking about Asia high yield. So this is a really interesting opportunity. So I'm going to say, first of all, we actually have the only US listed ETF that buys specifically Asia and specifically corporate high yield in this region. So that's really unique exposure that you're not going to get anywhere else in an ETF structure. So that's the fund. That's the market we're going to talk about today. And the fund we're going to talk about today, that's ticker KHYB. So just to get us started, a little bit of an introduction, a little bit of background on CraneShares. So we were founded back in 2013 by Jonathan Crane, who started a successful media and entertainment business in China. And that was actually the first business, one of the first in the world to use QR code mobile ticketing. Ended up selling that business to Ticketmaster in China, came back to the United States, realized that US investors didn't have a very convenient way to access China's capital markets in a passive vehicle, saw the rise of ETFs, and kind of married the two concepts, and thus CraneShares was born. Since then, we've expanded far beyond China, taking what we've learned in their markets and applying it elsewhere globally and across asset classes. So we have a very comprehensive product suite covering global markets, including some climate products, including carbon credits. We have the largest carbon credit ETF and a number of alternative strategies. And so KHYB, which you see on the top left, is our fixed income strategy for Asia high yield. So talking about the Asia high yield markets, so the bond market generally in Asia, right, has tracked the region's quite exceptional economic growth over the past decade, right? So growing from 250 billion, about 250 billion in 2010, to today almost $1 trillion in market size. So that's kind of the opportunity size here, right? And if you look at today, you're getting a bit of a higher yield compared to US high yield when you look at Asia. Okay. Now this is emerging Asia, so it's generally going to be Asia ex Japan that we're talking about here. And this is a really interesting opportunity, we believe, and for a variety of reasons that I'm going to get into. But big picture, right? What's going on in the US? You have Moody's recent downgrade of the US debt, right? Which, doesn't really mean that much to markets, right? And is not forward looking, right? But it is a statement of an observation of a current state of affairs where, US government has a high budget deficit that's set to maybe increase with the new bills being introduced. So that's a really risky situation. And that's causing a lot of volatility and expectations for interest rates, and therefore volatility in bond prices in the United States. So we're really seeing our clients that we work with and other people that we talk to looking internationally for fixed income exposure. Now, there's a lot of places you can go for international fixed income exposure. So I'm going to try to kind of convince you or point out reasons why Asia, specifically Asia high yield corporates, are particularly interesting right now and also going forward. So just to point out about the fund, this is an actively managed strategy. So we chose our active manager, that's Nikko Asset Management. So their team is located out of Singapore, but they're a Japanese asset manager. They're one of the most experienced in this space. So the portfolio manager, Wang Leong, has 25 years of experience, supported by a team of 16 investment professionals. And they do their own both top-down macro research and also their bottom-up proprietary credit scoring and credit research, right? So this strategy is really going to benefit from their expertise here, right? So they have, familiarity with all these issuers, right? The ability to invest tactically, the ability to they know what's going on in the market, right? But at the same time, this is also really an access product. So they're not looking to outperform the market that significantly. They're looking to kind of lessen your drawdowns and help a little bit on the performance side. So just to go over quickly, that's how the fund is run. So coming back to growth in the Asia bond market, right? So the Asia bond market has grown incredibly, 253% in terms of total market size over the past 10 years. So most of that has been investment grade issuance, as you can see here. And so the high yield market is a lot smaller, and it's a little more idiosyncratic, and not a lot of it's not really accessed that much in portfolios. When you think about high yield in emerging markets, and again, this is going to be mostly emerging markets, a lot of that's actually still sovereign debt, right? That's been downgraded. So people talk about like Argentina, right? Wild swings in their credit rating and their bond prices, right? So this is really focusing on corporates. And Asia is a place where you can really do this and do it successfully. So just again, stepping back a little bit, right? So Asia ex Japan is a huge part of the global economy, 1/3 of global GDP. But if you own global aggregate exposure using the Bloomberg Ag, right, that's only making up 15% or so the Bloomberg Ag. So again, if you look at your fixed income portfolio, I would imagine that you don't have exposure to this. So this is a really kind of diversifying potential here. So first, just going into credit quality. So starting from the bottom up, right? The companies that we're looking at for Asia high yield have very attractive interest coverage ratios. So that means that they have the money that coming in to more than 4 times over pay their interest payments and make good on those debts that they have, right? So usually you look at a interest cover ratio of kind of 3%. It's considered very good for high yield. And then here in Asia, you're looking at 4 to 5, right? And we saw that actually come up 23 to 24. From 2023 to 24, excuse me. So that's really positive. The financials of these companies remain strong, and they remain strong, as we noted in a recent research piece. These companies remain strong even in the face of trade protectionism and global trade uncertainty, right? And there are a few reasons for this that we get into in the research piece. So just high level. Number one is because in the high yield space in Asia compared to the investment grade space, all of these issuers are locally oriented. Almost all of them are locally oriented. They're serving local markets. They're not exporting. There are exporting issuers in Asia, a lot of them, but they're mostly in the investment grade space. So when you magnify, when you look at Asia fixed income and you go into the high yield space, you're mostly 100% focusing on local demand, right? Moreover, even given because of course there are indirect effects that you have from trade protectionism and trade tensions, but in Asia, you have these massive local markets, some of the largest in the world, growing at high rates. So there's so companies that export whatever it may be, whether it's electronics or raw materials, can easily pivot from maybe they're doing a lot of exporting in the United States, and they could easily pivot to countries like Indonesia, Thailand, that are all in the region right there and are growing quickly and are very large in and of themselves. So just looking at kind of the market dynamics recently, so you've seen issuance come down significantly. So we kind of saw issuance peak in 2019, averaging 50 billion annually since 2014, peaking at about 120 billion in 2019, and 2024 actually saw the lowest issuance in the past decade. Now, why is that? That's mainly because of, and I'm sure you've heard of, the crisis, the real estate crisis in China starting 2021, 2022. And so that really depleted the supply of high yield bonds in Asia's market. And so that's where you're seeing this extremely low issuance in 2024, the lowest in a decade, because these developers are no longer issuing bonds. Some of them defaulted. Some of them are no longer in existence anymore. So that's why you're seeing this really low issuance, right? But that's also an opportunity because number one, the space is now more diversified beyond these heavily indebted real estate developers now. And number two, just low supply generally, as you're seeing more demand come in for these bonds, and low supply may lead to price appreciation. So this is just kind of a macro comment here, right? You're seeing relatively tame inflation in the Asia Pacific region that we're talking about, right? Compared to like Japan. So even with their rate hikes, right? Japan's real yield on the government debt is still negative. Meanwhile, you have, very positive real yields in a lot of the countries that are focused on by this fund. Now, again, this is not a sovereign fund, it's high yield funds, and it's USD denominated. So this isn't as directly relevant to this fund, but just as an overall macro comment, you're seeing more tame inflation in Asia and really kind of positive economic dynamics that are unique versus the rest of the world. So looking at credit spreads here, so we have the US corporate high yield, Asia corporate high yield, right? And you're looking at this difference, right? So Asia corporate high yield has a higher spread than, US and Euro corporate high yield. So right now, and you saw that spread peaking again around the time, peaked once in 2022 and then again 2023, 24. And that was stemming mostly from the real estate crisis in China, right? And then you're seeing the spread kind of pick up again beginning of this year, mostly stemming from, concerns about global economic growth. And so that's where you're getting this kind of attractive entry point. Again, you would have had an attractive entry point 2023 as well, right? But that was amidst a real estate crisis in China. So there were a lot of risks going on, and we've seen those risks really come down. So again, that's why we believe now there's a more attractive entry point, even though the spread's not as high because the risks are lower. So over the past 10 years, the yield to maturity offered by these bonds has been an average of above 7%, right? So, you're getting kind of similar yield to right now what you'd be getting in the United States. So using the iBoxx High Yield Index, you're looking at in the United States a yield of about 7%, probably a little less than 7 though. And so you're getting kind of the same yield. But the really interesting part about this fund and this asset class, so Asia High Yield as an asset class, is the duration. So you're basically cutting, if you have EM high yield, you're cutting your duration in half by allocating to Asia high yield. This is really interesting because and again, as I said, this with a yield of 7% matching US high yield, matching pretty close to emerging markets high yield, you're cutting your duration in half without sacrificing any yield. So that's what's really powerful that we believe about this asset class, because you can really use it as a tool to dial up or dial down, really to dial down your duration risk. So that's your interest rate risk, right? And we think that's really key right now, where there's a lot of uncertainty around what path the US Fed is going to take when it comes to interest rates with everything going on in the global economy. So coming back to risks, so we're looking at the default rate here for, EM regions. So in Europe, Asia, Latin America, the Middle East, and then also looking at comparing that to the US high yield default rate. So you've seen default rates really come down from that high. In Asia, you've seen the high of 16.9% in 2022, and we've seen that come down significantly to only expected to be about 3% in 2025. Again, that's in line with other regions between Europe, Latin America, right? So that's really, really positive here. And again, that's coming from really the end of this long, lasted 2 years more of this real estate crisis in China. And we're seeing that ending. We're seeing those bonds no longer being in the market, those problematic ones, right? That's bringing the default rate way down. So moving on to the next slide. So yeah, just getting into some of the characteristics here of the fund, right? So the total market size. So this is looking at the JP Morgan Asia Credit Index, which is the benchmark index for this fund. So again, it's an active strategy, but it's picking from this universe of the JP Morgan Asia Credit Index, non-investment grade, which is a universe of 112 billion in terms of in market size, right? So again, you're getting that super low duration compared to US high yield, compared to almost any other high yield market. This duration is significantly lower. It's 2.05 years as of the end of the first quarter. And then, so we look at the 12-month distribution rate at 10% with an average weighted yield maturity, again, of that 7%, pretty much matching what you get in US high yield. And, spread over the 10-year US Treasury, 300 basis points. Again, matching what you're getting in US high yield, but that significantly lowering your duration. I think US high yield duration right now is about 7, 8, 9 years. So you're really taking on a lot of interest rate risk when you look at US high yield. Compared to look at Asia high yield, you're getting a lower duration for this. You're getting the same yield and you're getting relatively the same risk. In some cases, we'd even argue you're getting a little bit less risk in Asia on the trade front because again, Asia high yield, the issuers you're accessing are not exposed to as much to international trade as it would be if you were looking at investment grade. These are mostly serving local markets in growing economies. Whereas if you look at US high yield, a lot of the companies that are issuing debt are ones that are heavily reliant on imports, right? And the cost of imports, if the cost of imports is going up, obviously we've seen some movement there with, this recent case saying that, Trump couldn't use the Emergency Powers Acts to enact tariffs. So we'll see what happens there. But then again, this does bring risks. That is bringing a risk to the US high yield market, we believe. And so we think that adding Asia to your portfolio, adding Asia high yield could really benefit both from from lowering your interest rate risk and also lowering your exposure to trade risks. So looking at the characteristics, excuse me. So here we have a country breakdown, sector breakdown of the portfolio. So, you've got a lot of countries kind of across the Asian region, mainland China, India, Hong Kong, Macau being the top ones, followed by the Philippines, Indonesia, Mongolia, Thailand. So this is a really diversified kind of basket representing a lot of different countries. So you're kind of diversified in those risks. So the China weight, I will mention, has come up recently over the past years. And that's just because the manager is slightly overweighting the China bonds in the benchmark versus the benchmark currently. And the reason for this is because they find that now most of the issues available in the market are the ones that are in terms of the real estate developers, are the ones that they're a lot more confident to say, okay, these are the ones that are safe, relatively safe, and can pay their debts and are supported by the central government in kind of repairing the real estate market and building it back up. And then we also have Macau, which is a really interesting story, right, in terms of issuance. So that's a lot of these casino stocks, so Wynn Macau, and a lot of these have benefited from kind of a return of where China's stimulating the economy, right? That leads more people to kind of go to Macau. So that's an interesting story there. And again, the manager takes a view that, okay, their cash flows are becoming safer and their bonds could be rated as well. And then looking at a sector breakdown here. So real estate is 29% of the portfolio. And specifically China real estate, just to be very clear here, is about 20% right now. And again, that's probably going to go lower as these bonds re-rate and the manager rebalances back into closer to the benchmark weight. So the manager has to remain within a band of the benchmark. So he has the decision to go overweight, underweight there by a little bit. So that'll probably come back down a little bit as time passes. And then, of course, financials. So that's where you're looking at a lot of these countries where the manager sees, there's positive economic growth, right? And there aren't a lot of most of the issuance is going to be financial in a lot of these from financial companies in a lot of these emerging developing countries. And then, of course, utilities and consumer facing companies, mining. So again, it's also a very diversified basket in terms of sector. So that's really positive from a risk perspective. So yeah, in conclusion, right? So as we've said, you've had steady growth over the last decade, growing 250% from $300 billion total market size 2010 to almost $1 trillion today. It's underrepresented in the global ag. Asia ex Japan, right, is attractive specifically because of its low duration and low credit risk, right? And then we have an absolute star, in our opinion, active manager who is running the fund for us. So that's really positive. And so, again, this is really where you get the idea is, you can really lower your duration risk by taking with the same yield, right, that you get versus the US, right, by allocating to Asia high yield. And another note on this strategy in particular, so we actually run this, Nico, right, has been running this strategy for years in select markets in Japan and Korea and Singapore domiciled funds. So there, if anybody's interested, right, we can provide a track record of those funds. Those have been invested by institutions for many, many years. So that's really positive in terms of, this is a young fund, right? So we started running this strategy with this ticker in August of 2021. But if you're looking for kind of a longer history, right, we can point you to those, offshore domiciled funds as well. So, and then this is just a description of top 10 holdings, another description of the fund. Yeah. I think, Michael, we have plenty of time for questions. Are there any questions coming in?
I don't see yet, but those that are here, again, just to reiterate, for those that want the CE credits, we'll do that. I'll email towards the end of this. But I want to make this interactive. If you have questions as we're chatting, we'll kind of turn this to a little bit of a live podcast here for a bit. And I missed a part of it in the middle, but I do want to hear thoughts on sort of concerns around bonds as an asset class, how to think about corporate credit in the context of the equivalent of that for Asia's bond market, and any concerns around sort of sovereign debt risk, which is, I think, always in the back of people's minds.
Yeah, I think there's a lot of sovereign debt risk out there. The US is coming up as a sovereign debt risk with Moody's downgrade. I mean, and that's always, like I said, that doesn't matter that much to markets, right? It's very backward looking. It's not forward looking. But it is a state of affairs, right? I think that you're going to have a lot of risk in terms of interest rate risk. I think the BOJ could do another rate hike, right? And that's going to insert certainly equity market volatility, but also potentially fixed income market volatility. So, and then sovereign risks. I mean, in a lot of the world, it's looking a little bit better now. Certainly Argentina, right? You've seen a lot of fake situation improving there. They have the new president in, but a lot of these countries will see. I think a lot of this depends on what happens with trade, right? A lot of these countries are heavily dependent on exports to the United States and the rest of the world, right? And that's going to reduce their tax revenues, which could lead to increased default risk in sovereigns. And to point out, right, when you're buying broad EM high yield, if anybody is, you're also getting sovereign exposure. That's not just corporates, right? So usually when we think of high yield in the developed world, right, we're thinking of pretty much just corporates, right? But this, and again, that's another thing, another reason why it's very interesting, but that's why the strategy in this asset class is so unique, because it's all corporates, right? And it's still emerging markets, right? And so that's why we think, again, a very unique risk profile, an excellent way to reduce your duration, reduce your interest rate risk without sacrificing yield. Yeah, and then, I mean, U.S. high yield, right, has actually done quite well last year and then so far this year. But there's a risk, right? Because if you have interest rates going up in the U.S., I mean, we saw a 30-year hit above 5. Personally, I think the 10-year could also go up to 5 or above in the U.S. And then obviously that causes a re-rating in high yield, right? Which high yield has done very well in the U.S., right? So, and then we don't know if the Fed's going to cut, right, rates at all this year. I mean, I think it looks like they're going to do at least 1, maybe 2 this year, and that's the consensus. But, we had a consensus for a lot more than that when this year got started, right? And we just haven't seen anything. And that's because this outlook is just so, the outlook for the global economy, outlook for the U.S. economy is just so uncertain.
A question from John: how restricted are the covenants?
The covenants of the underlying bonds?
Yeah, the underlying bonds. I know it's a broad question, right? But I mean, typically are the restrictions more significant than what you would typically see in the equivalent in the U.S.?
No, it's pretty much in line with what you would see in the U.S. Again, a lot of these bonds are, you're looking at maturity dates like 2, 3 years out. Like it's all pretty short term, right? So I don't think that becomes as much of an issue. But, John, definitely. So, in the portfolio, we've got, so this is 80 bonds. I think today now it's 71. So there's, quite a few in there. And I'm sure some of them, if, it is an interesting question. And I think certainly our manager, Nico, would know a little bit more about the covenant specifically. But my understanding is it's pretty much in line with what you would find in the U.S. high yield space. And I think it's a little bit less relevant just because the maturity is so much shorter term. And then just to get in why that is when it's shorter, why it's so much shorter term is that, you actually have the main buyers of these issues have been local private banks. And that's always been their preference, is just for shorter term money, right? And so that's kind of why we see this. That's why it has this characteristic, right? But John, I'd happy to follow up and give you more information about covenants.
Another question, just looking at the price performance. I think it's actually become differentiate between total return and X.
Yeah.
what's caused the ETF price to drop from $40 in 2022 to 24 currently. Obviously, we all know 2022 was the brunt of that duration, bond market, bear market. And is there potential for price appreciation? How would that unfold from Neil?
Yeah. So for this fund specifically, first of all, I noted that, this fund, if you look at the price history of this fund, it has a very long history going back to 2018, 2019. So that was actually, but it was a different strategy until August of 2021. So if you want to know the track record of this strategy specifically, you have to start at August 2021 specifically. And this is noted in our fact sheets and materials. So that's really coming from, the China real estate crisis was very impacted. The fund was very impacted by that. China real estate developers until last year were a very, very high weight, making up 40% or higher of this benchmark index. And so this universe that the manager has to pick from. And so that was a really chaotic and challenging period for the Asia high yield bond market, just because those developers in China had become so indebted that they were representing a very high percentage of the market. Now that situation has changed quite dramatically, right? So right now, when you try to think about price appreciation and making up for some of that price decline, right? That's where we're looking at the manager kind of tactically picking certain bonds within the China developer bond space that they think their cash flows are relatively safe. And again, those are probably the only bonds that are in the market today, because so many of these issuers are not there anymore, right? So you're seeing a really different risk profile today. Furthermore, we think, the manager thinks, and so do we, that think that a lot of these developer bonds are due to re-rate. The government has come out with strong indications in China that, okay, the real estate deleveraging is over. They've kind of accomplished what they needed to on that front, and they need to get the property market going again. So one of the big issues was pre-sales. So a lot of people had purchased homes that were yet to be built and still many of them have not been built yet today. So one of the priorities, kind of after they got the deleveraging done, one of the priorities has been making sure those homes get delivered. So Nico has extensive research on this, which I'm happy to send to you, where they've said, look, we're going to invest we're going to buy the issues by the developers who are basically receiving support to complete those projects, right? And so their kind of cash flows are relatively safer. So we think there's high potential for price appreciation as well. And again, that's also stemming from not only the issues in China real estate recovering, but also this complete rock bottom issuance you saw in 2024, right? So you're going to have more buyers coming in to this market, especially and specifically the USD market, just because local rates are quite low. Actually, in Asia, you've already seen central banks begin a cutting cycle in Asia, right? So you're actually seeing we think there's going to be more demand for these bonds which are USD bonds, just because local rates are lower. And then combine that with the low issuance. And we think there is a high potential for price appreciation.
Is it fair to say that if you just given the spreads, I saw that chart earlier, that if you think about it from an undervalued, overvalued perspective, that these bonds are more properly valued relative to what we're seeing in the U.S. high yield bond space? I mean, I've made a point for a long time, maybe too long, that spreads are way too tight relative to where default risk potential is in the U.S.
Yeah, no, I mean, difficult to say, but I would be inclined to agree. Very tight spreads in the U.S., as you can see here. And there's a question of whether or not that is justified, right? I think, and again, as we saw, like I mentioned earlier, 30-year treasury going above 5%, potential for the 10-year to get up closer to 5. That's just gonna, that means spreads are gonna even contract even more in the U.S. is what that would suggest, which I don't know if that's justified, which means it's going to be a big re-rating, and there could be a big re-rating in U.S. high yield. Yeah, difficult to say, but certainly, you're seeing much more attractive spread in Asia. For what I would actually argue, and again, it's difficult to say, for, relatively, you're not really increasing your risk that much, I would say, compared to U.S. high yield, versus like if you go into other parts of EM, right? And again, that's because these are mostly shorter term issues. Economies in Asia are strong. And these companies have very strong balance sheets and are generally pretty conservative. That's one thing we don't see just culturally speaking in Asia. You have they don't from a corporate side. I mean, governments borrow a lot, real estate borrows a lot, but from other kinds of corporates, you don't see this heavy use of debt, and it's more short term, right? So I don't want to say you're reducing your risk versus high in U.S. high yield necessarily, but you're not increasing it significantly, and again, you're getting the same yield and you're getting shorter term, lower duration.
How volatile? I mean, again, I know it really is a spread movement, but typically, how reliable is a yield at a moment in time when it comes to looking at Asia? Meaning, can we have confidence it's going to be in sort of a tight range relative to the current 30-day SEC yield? Historically, is there a lot of volatility in that yield? How wide is that band?
So we've seen the funds distribution rate, for example, right over the past year has increased by 7%. And again, that's the rate. So relative to the share price at the time and what we're actually paying out, and we've seen that actually go up a little bit, but it's been relatively stable. So if you can look at our distributions, of course, on the website, KraneShares.com/KHYB. We've seen that be relatively stable. Of course, we have year-end distribution that is higher just because we have to pay out capital gains given turnover in the portfolio. And so, yeah, pretty stable in terms of the actual coupon payouts and then what's being paid out in the fund, I would say. I want to say, I mean, it depends on what you're looking at specifically for in US high yield. I would venture to say that this is a little more stable in terms of the payouts you're getting. And again, that's still, I think, coming from the fact that this is just shorter term, issues.
And just to reemphasize the point that these are U.S. dollar denominated, from a tax treatment perspective, there's nothing to think about or consider.
I can't really give tax advice, but this is income from abroad. So I think even though it's USD, there still are potential tax implications. Yeah.
Talk to me a little bit about correlations here.
Yeah.
Because I think so when we think about diversification, it's not about the number of positions, it's about the correlation components.
Yeah.
I want you to expand on that, not just in terms of correlation against fixed income in the U.S., but maybe intra-portfolio correlation, meaning typically do you see when you're investing in Asia bond markets that these countries tend to co-move similarly, or how the correlation also from that standpoint?
So from a country perspective, yeah, I think there is significant correlation one to another, apart from kind of very country specific events, such as, like when you saw, in the China real estate kind of crisis, you did see the entire space, spreads widen, but a lot of that was just, it was so much more severe within China, right? So you do get those kind of country specific risks. But otherwise, yeah, within intra-region, the correlations are pretty strong. And then the correlation to U.S. high yield and global high yield is very low, though, right? So you do get this intra-regional higher correlation, but then that compared to the rest of the world is very low. For instance, it's over the past 3 years, you're looking at a correlation of about 0.3 to U.S. high yield. So this is which is we believe is very attractive for diversification purposes. But then the intra-regional kind of correlation, right, does support the idea that, right, this can be looked at as, a single asset class here.
What do you think we see in terms of, actually, that's the question from Michael, but Michael asked if you have an equivalent ETF in local currency. We should talk about the currency component.
Yeah, we do not currently know. We don't. I think that there is coverage already, right? In local currency, there's a number of ETFs I think that are tracking local currency EM. Not Asia specifically. I think we are the only U.S. as an ETF to track Asia specifically. I believe certainly in high yield. I believe also in investment grade. Yeah, I mean, if you were looking for more currency exposure, right, which would make sense right now, given that the U.S. dollar, we're seeing a U.S. dollar weakening, that, this doesn't give you that, right? But it does, global currencies getting stronger, obviously do have an indirect impact and benefit to KHYB because, again, all of these issuers their revenues are denominated in local currency, and then they're using that to pay off the dollar debt, right? So it does decrease your risk, current kind of currency risk here, albeit indirectly. And no, we don't currently have a low currency fixed income product.
From the standpoint of expectation around default risk, is there anything to suggest that a weaker dollar, a stronger dollar against these country currencies makes the default risk dynamics of these corporate bonds different? Meaning, these bonds tend to perform generally better when the local currency is appreciating or depreciating, separate from the currency conversion.
I would say, yeah, they tend to perform better when the currency is appreciating for USD.
All right, so that becomes sort of a consideration, obviously, right? If you're going to have a view on this, you also want to consider, obviously, to the extent that one does have a view on currency, that becomes an important dynamic. There are a number of other Asia emerging market bond ETFs that are out there. Many of them are passive in nature. Let's talk about sort of the benefits of security selection with what you guys are doing.
Yeah, sure. So bring it back up. So yeah, Nico Asset Management, super experienced in this space. They've got a great team, and they're out of Singapore, and they're very communicative. We do a lot of calls with them, with clients, and they really know what's going on. They do a lot of research, and what's really key about their approach is this bottom up credit research that they do. So they don't actually rely on they rely on the benchmark for the universe, and then they actually do they have their own credit ratings basically for all of these issuers. So they're not relying on S&P or Moody's necessarily, other than insofar as that's what decides what goes into the benchmark. They do all their own credit research. So that's kind of really powerful here. And we saw this really playing out over the past couple of years. We did have a lot of drawdown because of China real estate, but they were also able to avoid a lot of defaults from that space that were captured by the benchmark. So that was really positive. And so we do a lot of work with them. So if you subscribe to our research, we'll periodically be publishing kind of thought leadership pieces and research that's coming from Nico as well for our fixed income topic. So that's really interesting. And, these guys are really one of the best. But again, it's not like they have to stay, they still have to stay within a band of the benchmark of the JP Morgan Asia USD high yield non-investment grade. So, but those bands are mostly in the country and sector, right? And then they're basically within that, they're completely able to choose the specific issuers, right? So that's why you have, I think I have it in here. I don't have it, but so it's 80 bonds in the portfolio versus quite a few more, like 1,000 in the benchmark. So it's very selective.
So talk to me about liquidity and volume. Because obviously the issue with anything that's international is different time zones, in terms of what's being traded, and then when dealing with bonds in general, it's less liquid. Individual securities versus equities as an asset class. Talk to the audience here about that.
Yeah, sure. So, again, that's why our partner Nico really is helpful here, right? I think we would find it difficult to be trading these bonds, right? Sitting here in our US desk, and right. So that's why it's really important to have a local partner. And they also have a lot of inventory because they run the strategy elsewhere. So I think that also helps them with liquidity. But most of these issues are pretty liquid, I would say. There's a lot of demand from local private banks, like I mentioned, and they're all USD. None of that matters so much from a liquidity standpoint and shorter term. And yeah, it just generally you're seeing, I think these are more liquid than certain other emerging markets, right? And that's why when you look at, kind of the more esoteric countries, for example, so like Mongolia, for instance, right, is represented in the portfolio, but that's like two of the top banks there. That's like their bonds, right? So those are going to be fairly liquid, even though it's kind of more of an esoteric area. And again, that's where kind of our active manager is very helpful in this. And we really think, going back to our process slide, right? Active management is super important, even for an ETF in fixed income for these liquidity issues, especially when you're going internationally. And not only that, but also because fixed income indexes themselves will overweight. They have a bias toward actually more debt because the equivalent of the market cap weighting is the indebtedness of the company, right? So for fixed income, that doesn't work out quite so well if you're just kind of blindly following an index, right? So even though these guys they're not making big moves versus the index in terms of sector and country. They are doing that from the issuance selection level and using their own credit rating, so they're really able to assess this, going beyond just kind of what the weight in the index is, because these index weight, I mean, that's why you had in the China real estate crisis 2022, these developer bonds were way, way overweighted in the index just because of their indebtedness, right? And so that's another way where asset management can really, active management in fixed income specifically can really help for bond exposure.
Yeah, I love that point. Most people don't realize that
Yeah.
the market cap equivalent is how much debt, which is just perverse because you're putting the most amount of weighting in the most indebted individual issuance.
Yeah.
Yeah, which that is the biggest flaw, obviously, of the bond side. There's a attendee again with the caveat on the tax advice side. If you happen to know this answer, is there withholding tax on the distribution if you live outside the U.S.? I guess it depends on which country. I would say is sort of the way my mind thinks about it.
Yeah, it would depend on which country. You'd have to to your local tax expert. I can't really give any specific advice on that front. Yeah.
Yeah, that makes sense. Okay, and then maybe on the final point here, and again, folks, for those that are here, appreciate those that are attending. For those that want to see credit, I will email you after this webinar. The question is, what do you typically see in terms of allocations? Let's talk about weightings, not investment advice. Particularly, what do you see other advisors do in terms of how much of a portfolio, how much of their EM, international exposure, goes into this type of product?
Yeah. So we see people thinking about sourcing from either their US high yield or their kind of EM, not necessarily high yield, but EM exposure, just because that's like broader EM high yield is just a very much a different beast from this, right? This is kind of right in between in terms of risk return. You're kind of right in between US high yield, and you're right around US high yield, and then kind of EM, but more investment quantity, more towards the investment grade side, just because these are, again, shorter term, right, issues. So we've seen people source fund from both places. And so that's kind of really interesting. And again, use this very much as a tool to reduce our duration risk. Very powerful. We run this in our own model portfolios. We use this as a significant part of our fixed income exposure. And again, so we use that in our strategic wealth model, which is a multi-manager model. So we're using this. We have this, and then we have kind of ag exposure, right? And then we use this as a tool to dial up or dial down that duration risk, right? And we've seen that approach being kind of appreciated by clients and implemented. And again, because you're really getting the same right now, you're getting the same yield as US high yield, right? And then you're lowering your duration risk. So that's kind of the main way we've seen this being implemented, and we've implemented ourselves in our own models.
Henry, for those who want to maybe get access to the slides or want to follow up in some way, shape, or form, what would you recommend for them?
Yeah, so you can go to CraneShares.com/KHYB. And so there you're going to have all the information about our fund that's available, and you can access this very presentation that I've been speaking to right there on the webpage. And you'll also be able to see all of our distribution history, as well as other relevant information about the fund. I also encourage you to write on that same website, CraneShares.com, subscribe to our research, and also reach out to us. So we have an email line, info@CraneShares.com. And for those interested financial advisors, we'd be happy to speak with you individually, and we can even connect you with the Nico team out in Singapore as well. So they're a great resource to us and to our clients. So happy to share that as well. We also have a daily market update on China and Asian markets. It's mostly stock focused, but if that's of interest, so that's ChinaLastNight.com. You can subscribe right there.
Appreciate those that watch this webinar. Learn more about CraneShares in general on their website. Special thanks to Henry, and I'll see you all next week. Thank you, Henry. Appreciate it.
Yeah, thanks, Michael. Thank you, everyone.
Cheers, everybody.